Hey guys, what's up? How's it going? Welcome back for another video. This is going to be October's update for our stock portfolio, and it is the 15th of doing this video, so we're in the middle of the month. Hope you guys had a good Thanksgiving. We just kind of finished the holidays there. I got a day off today, so we're going to be doing a video today, and I'm going to be combining my regular updates with the margin account updates. These are two separate series that I normally do. Since I have some free time to do it, I'm just going to combine them together. So I'm going to add this video to both playlists. So if you guys are following either one of those series or the video series, it's going to be combined into one today. We'll cover the regular stuff today first, like our portfolio updates or dividends, all that kind of stuff that we talk about, and then I'll be doing the margin stuff after. So that's going to be towards the second half of the video. So if you guys want to watch that, stay tuned for that. But yeah, that's the way we're going to do it today. So it's going to be a little bit of a longer video than I normally do for that reason, probably. But yeah, we're just going to get into this. Before we get started here, if you guys want to follow me on Blossom, there's an app in the description of today's video. You guys can sign up, it's completely free. You guys can see all my portfolio. You guys can see my holdings. You guys can see when I'm buying my stocks and whatnot. And most of the time when I do buy stocks in there, it's in the margin account. So every single morning when I buy my stocks and whatnot, they're going to be on Blossom. But you can also see all my holdings and everything in one place. So check it out if you guys want. Link in the description of today's video. If you guys do sign up, it does help support the channel. So check that out if you guys want. It's completely free to do so. Anyways, let's get going here. So here's the portfolio. We'll talk really quickly about what's been going on over the past, couple weeks or so since we've done the last update, and we've seen quite a bit of growth inside the stock market in general as things have gotten up quite a bit. So we have 224,000 inside my Wealthsimple accounts. We'll cover my accounts first, and then I'll show you guys everything and all the different accounts we have in just a second here. But yeah, 1 month return for my accounts, we're up about 2.78%. So quite a bit of growth of last month, more or less. Last 3 months we're up 10%, about $20,000. 6 months we're up 25%. So we can see it's been a pretty good year, more or less, with lots of growth coming towards the second part of the year or towards the end of the year. And it'll be interesting to see what's going to happen as we get towards the end of 2025, as markets just kind of keep going up. Which is kind of surprising, kind of not surprising, but that's just the way it's been going. Year to date, we can see, the start of the year was okay. We saw that bit of a dip in April, and then now we're even going into new highs, about 16% year to date so far. It's about $30,000. So again, the portfolio has done quite well, and then all time, we're up that 80%, which is about 6 figures. We finally hit 6 figures. I can't remember if we did in the last video. I don't think we did, but we finally hit about 6 figures net gain inside my own portfolios on Wealthsimple, which is pretty crazy to think about. But anyways, we go down here. I'll show you guys my accounts here. Let's just close these up. So the TFSA, $189,000. The first home savings account, about $19,000. This is the main focus. TFSA is maxed out, so I'm not worrying about that. First home savings account is the new thing for me. It is maxed out this year. So you don't have to worry about that. And then the RSP. So at this point in time, if I'm putting any money inside my own personal account, it's going to be inside the RSP. And then I have my partner's TFSA that we're maxing out, as well as their first home savings account that we're going to max out towards the end of this year. So and make sure you do, if you guys are putting money inside your first home savings accounts, make sure you do it before the end of the year, before the start of the new year, because your contribution does, basically you lose it every single year. I'm pretty sure you can only put the $8,000 per year. Could be wrong about that, but I think that's how it works. So actually, I could be wrong about that. Actually, I think the way it works is you have to open your account. If you have it open, then I think it carries over. So ignore everything I just said, because I think that's wrong. But anyways, just make sure to look it up, because sometimes it's very easy to make mistakes. But here's the RSP. Again, we're just growing this very slowly. For the main reason for the first home savings account and the RSP is for a down payment for a house. So we're going to be using both those accounts, but we are prioritizing the first home savings account because it is the better account for that case, but we can pull some money from the RSP if we need to. So yeah, that's the focus there. And then we have the margin account here. We'll cover this towards the end of the video, but it's about $264 in total. Again, we'll cover that towards the end of the video. But yeah, that's the accounts here right now. Let's kind of do a quick little dive inside our stocks here. So this is our stocks inside our entire holdings. I think this is averaged out across all of our accounts. So we can see like VFE is our biggest holding by far, represents about 60% of the portfolio. We're up about 44% in terms of net gain. I don't think this includes dividends, so kind of keep that in mind. Actually, I know it doesn't include dividends, so this is just stock growth. It's not accurate in terms of dividends. A lot of these funds, especially the higher yield ones, have the dividends, increases it by quite a bit, so just kind of keep that in mind. but you see pretty steady growth across the portfolio as a whole. The only thing that is negative is CNR, which I will be selling. I keep saying that and I just forget to do it. But we have about $500 in CNR. We'll probably just sell and stick into our Canadian ETFs or something like that. But other than that, it's a pretty basic portfolio and nothing fancy. You got a mixture of different things. We got growth, we got dividends, we got some high yields, but it's fundamentally a growth portfolio at the end of the day, with a little bit of other things sprinkled in here just to give us some flexibility and whatnot. So that's a quick little overview. Let's jump over into passive. I'll give you guys an overview of our accounts and we'll check with the dividends for the month. All right, so here's our passive account as I'm going to show you guys. So in total, we have about $329,000 across all of our accounts, and we did get a nice little gain in the markets. As you guys can see, we got a nice little growth since our last update here. See my cat here, she's coming to take a visit here. $329,000, yeah, big gain. I think when I did the last video, we were up about $300,000 in total, which was huge, but we've seen like that little jump happen. We also put some more money in the market, which helped bump that up. Yeah, and the accounts have just been growing like crazy since we started them. So it's been pretty consistent, pretty good. The other accounts we'll cover here just really quickly so you guys can see here. So here's my partner Tamara's account here. She's about $96,000 inside her TFSA, and her first home savings account is about $9,000, which we will be bumping up another $8,000 towards the end of the year to kind of max that out. And then we have our other accounts here, which there isn't anything else here. So let's jump on the reporting tab, and we can also see some other metrics here in passive. So we can see things like our dividends and whatnot. We'll scroll down here to the dividend history page, and let's go. Let's kind of look at October 1st, I guess. So you have 1,200. Sorry, my cat's here, just being a little bit of a pain in the butt here. Whenever I move things on the screen, she's always chasing things, and yeah, she has a great time. She's still a kitten, so she's actually surprised she's being so calm right now. Usually she's running around in the background causing trouble, but it's still early in the morning. So, but anyways, October was $1,262. Pretty crazy. I think that's a new high for dividends inside the entire portfolio. Looks like it is, because in April we hit 1,000, July we hit 1,161. Then October we hit 1,262, which is pretty crazy. It just keeps growing and compounding. And again, guys, we're just putting money in. We'll keep growing it. If we go all time, we can see by year. So this pretty big growth since we first started investing. Obviously, here, I'm going to put you down again. In January of 2020 was the first year I started investing. We made about $100. That was about it. In 2021, we made about $1,000. In 2022, we made $2,000. In 2023, we made about $4,000. In 2024, we made about $6,000. And then this year already, in January of 2025, we're already hitting at about $8,000. So it's been pretty crazy, like we're already growing it by quite a bit. Things just keep increasing. And I think by the end of the year, we might hit maybe $10,000 in dividends. Actually, it looks like it might be doable, which is pretty crazy. It's been pretty crazy growth since last year, about the $6,000 or so. So it's been nuts. But again, and one of the big things that has been growing the dividends more aggressively this year has been focusing more on adding a little bit more yield inside the portfolio, but also taking those dividends and reinvesting them and kind of, having the portfolio be a mixture of different things, right? Growth, dividends, all that cool stuff. So that's obviously really helped the portfolio out and has made things definitely grow. And it's been great, guys. So anyways, that's the quick little update of the portfolio. There's not too much I really want to talk about. The only big changes I might have made is I can't remember if I talked about this the last video, but I did add C-Day. So C-Day is Hamilton's new covered call ETF. We added a small holding. This is just going to be a small holding inside the TFSA as well as in my margin account to bump up some yield. So I can't remember if I talked about in the last video. We did that. I sold off some FTN. We're going to make this a small holding inside the portfolio. I've decided I'm going to keep it. We're just going to trim it down to a small holding, and that's about it. And I've been buying a little bit of HHIS. Again, these are very small holdings. I think the covered calls inside the TFSA for my portfolio represent about 15% of the portfolio. I think 15-20%, somewhere around there. And again, it's split across all these different ones. And then we have, VDY and VFE, which is our biggest funds, right? So that's the bulk of the portfolio, and that's the bulk of the focus is on dividends and growth. Mostly growth with a little bit of dividends in there too, with a little bit of passive income. So we get the best of both worlds. And you can see it does bump things up a little bit. We still get nice growth. We still get capital growth. I mean, this year, year to date, we're up 16%. So it's done well, and we still get those nice dividends. So that's the whole focus there. But anyways, guys, that's it for today's video in terms of the regular portfolio. At this point, we'll jump inside the margin account and we'll focus on that. Alright guys, so now we're going to talk about the margin portion of the portfolio in today's video. And in today's video, we're going to do a quick little overview of the margin account, and then we're going to focus on interest rates. That's going to be the topic of today's margin video. And like I said, guys, if you guys are new to the margin thing and you guys want to see my previous videos, check out the playlist. I'll link this video to both playlists, like I mentioned, so you guys can kind of follow along. And with the margin account videos, we're basically going to be picking away different topics in each video. So each video is going to focus on a different aspect of margin investing and my strategy as well, because it is a bit of a complicated topic. And again, we're still learning and going through this as we go. So it's going to be kind of loosely based like that, but I do want to focus on one topic each day. And in today's video, we're really going to dive into interest rates and how we're kind of combating the interest rate of our margin account and whatnot. So quick little overview really quickly here. Here's the margin account. We have $264 in Canadian dollars inside the margin account. We have $214 in growth, plus 429%. So we definitely have some gains inside the margin account. Some of that is realized gains, some of it is unrealized, some of it is dividends. You can actually click here and you can actually see specifically what your performance is coming from. So we can see we have the $50 in Canadian deposits. This is what I put in to open the account. So before you can open an account on Wealthsimple, a margin account, you need to put some money in. So I put in $50, and our all-time return, this is taking in your dividends, your realized returns, plus your unrealized returns, is about $214. And then unrealized returns, so this would be how much we're up in capital that we haven't sold yet, is about $100. And we can scroll down here, and again, you can see a return percentage. So with a margin account, you can get a pretty high percentage, because remember, we did make this money from nothing, right? It was from $0. So obviously to make $200, that's a significant gain from $50, right? So you'll see high percentages, or even I should say $0. So it looks really good from a percentage, but the dollar amount obviously isn't there yet, but it will grow over time. Our realized returns is going to be the shares that we've sold. So we have been trimming some sales as our stocks go up inside the margin account for a couple different reasons. Obviously to pay off the debt, but also to lock in some gains and to recycle our margin so that we can use it when the markets drop, like they actually did last Friday. So that was a good example of why we do that. It's because it gives us more money available so that we can redeploy it when markets drop. And again, it locks in some of that gain, so you don't have to worry about losing that gain. And then we have the dividends here. So $33 in dividends. I'm going to go over this in my spreadsheet and show you guys what months we made the dividends versus our interest rates to really hammer that in today's video, because that's again going to be the focus of the video. But also, if you guys are on mobile, you can actually click here and view the dividends by month, which is super cool. You can't do it on desktop for some reason, but if you guys want to see that, you guys can. But I'm going to show you guys that in my spreadsheet anyways as we go through today's video. So if we go over to the right side here, we can take also some other, take a peek at some other things about our margin account. So we have $5,000. We've creeped up in margin. And again, the way I deploy this is every day I check the markets in the morning. I have about $300 worth of margin that I kind of deploy if the markets are down. So I take a peek at all my ETFs. I look at them, okay, what's down today? And I basically spread that money out. And obviously the funds, based on my allocations, right now I'm a little bit higher in some of the higher yield funds, so I'm putting more in the growth funds and dividend funds, but that's what I do. And we've got the account up to $5,000 in margin. As you guys can see, we're taking things pretty slowly, but it actually kind of creeps up there pretty quickly. Before you know it, you'll get up to your max. And we're shooting for a 7% roughly max of our percentage of our portfolio, which I think is about $15,000 or somewhere around there. So we're slowly getting there. You guys can see we did link our TFSA to increase our buying power, and our interest rate is 4.7%. It did drop. I think I talked about this in the last video, but it did drop a little bit from the 4.9% we had. I think it was 4.9% with the interest rate reduction, and we do have another interest rate announcement coming at the end of October, so we might see a reduction, we might not, we might see it stay the same. I think more or less it's going to be like a 50-50 chance. So that might get reduced or it might stay the same. Either way, it's fine. But that's our current interest rate. And this is an important number to know when it comes to margin investing. You have to know this number because this is going to be how you're going to kind of build your account, especially if you're going to go through the dividend investing, or if you're going to, follow something that I did, which is like we're focused on basically beating the interest rate with our yield. You can see with Canadian funds, the 4.7% and then the 7% And in U.S. markets, obviously, this number is better to borrow Canadian dollars right now than U.S. dollars because you get such a lower rate. And then we can also see, accrued this month $7.22. So this is how much we've basically racked up in interest for this month, and then we got charged $11 last month. And again, I'm going to show you guys this in my spreadsheet how we track this. But keep in mind, interest is daily, not monthly. So as you buy in slowly over time, and as you buy in dips, what will happen is your interest will slowly get charged on the dollar amount. So basically, let's say you started from $0 and you put in $200 on your first day. Well, now at the end of that day, you're getting charged 4.7% of that $200. Let's say the next day you put $300 in. Now you have $500. Second day, you're going to be charged interest on the $500. And this is why, for other reasons, I also don't recommend you deploy all your margin at once, just for safety reasons. But also, if you put in like $10,000 from day one, you're being charged $10,000, 4.7% of $10,000 on your first day. So you're going to be paying more interest. So if you deploy it slowly over time, that's a way of reducing that interest rate. Whether it's relevant to you or you care about that, that's up to you guys. But it is a little trick, and that's how you'll able to get your dividends to basically outpay your interest rate. On top of it, because as you guys will see, our dividends are beating our interest rate by quite a bit. But anyways, that's a quick little overview of that. You guys can also see the stocks I hold, and I'm going to be doing a bit of a dive here, and I'll explain the reasons why I have these stocks as well. Okay, so here's the stocks that we have inside of our margin account. And like I mentioned, the big thing you want to pay attention when it comes to interest rate, or what I want to focus on, is to make sure that we're always making more yield than our interest rate. And the reason for this is because this 4.7% will get added on, that debt will get added on your account every single month. And if you don't have yield, it's going to keep compounding. This is where people get into trouble. So if you're investing in a very growth oriented portfolio, and let's say markets go down for 6 months, a year, maybe 2 years, or that stock just doesn't recover, every single month that debt is going to be added on and push you down more, and then it's going to be even more interest. And that's where people can get into trouble, especially over a long period of time if they're not getting that gain. And when it comes to margin, downward markets in the short term, in the long term as well as the short term, can affect you in a negative way. So basically, this is just reducing risk of, obviously margin calls and different things like that, which I don't think we really have to worry about with our lower percentage of a portfolio. But there's also like the psychological benefits and different things like, and it's just good practice, I think. So what we've done here is I have track my dividends. So this is basically a portfolio tracker where you can see your yield and stuff like that. So I punch in my numbers, and it allows us to easily see what our yield is. Our portfolio yield is going to be what we're getting in dividends, yearly and then monthly, right? And we have lots of different funds here. We have some traditional funds, like some growth funds, some dividend funds, some high yield funds, and they all pay at different times of the month. So there's a nice little spread there. But our portfolio yield right now is a little bit on the higher side. It's about 9%. We're shooting for a 6% yield. And the reason why it's so high right now is because I did sell off some of my VDY, VFV, XEI. I sold some shares. So it's, and I keep my covered call ETFs as a base for tax reasons and different things like that. But also I keep them, I'm not selling the covered call ETFs really for capital growth. I'm keeping them to beat the interest. I'm selling the dividend stocks and the growth stocks for capital gains, and that's mostly what's going to happen. Now, obviously with the markets going up a little bit, I might trim some of them here and there, because that can just happen, but we're mostly focused on selling some of our growth stocks. So, as we do a trim, our portfolio yield goes up a little bit, and then we just got to kind of bring it back down. So that 9% is a little bit higher than what it should be, but the main thing to focus on is, as long as your portfolio yield is going to be beating your interest rate, which is going to be listed down here. Again, it's going to be different depending on who you guys are with, which account type you have, but it's going to be more or less probably somewhere similar to this. But as long as your portfolio yield is beating your interest rate, you're basically making money every single month off your margin account. You're beating the interest, right? And that's good. And as you guys can see, when I bring up my portfolio spreadsheet where I track this, you can see on this sheet, I'll just kind of explain this really quickly for you guys. We have the TFSA, which determines our borrowing power, right? It's percentage of our margin. So if we use $5,000, that's 2.6% of my TFSA. Again, we're shooting for a cap of 7%. So as long as we're below 7%, we're good. In fact, it's a very low percentage. So we can keep buying. We can keep putting money in. And again, that's the reason why we do this slowly. And you'd be surprised at how quick this kind of creeps up on you if you're not careful. So take your time with this. You always want to keep some money available. We picked 7%. just under regular market conditions. If things do drop massively, we might bump that up a little bit because we have the flexibility in the room to do so, but we'll see. But anyways, here's the month here. So September, October, we've only had this account since September, and I think it was towards the end of September we made it. So on our first month, we paid $2.65 in interest, and we made $8 in dividends, give or take, a profit of $5. So that $5 automatically goes towards paying off the debt. We made money, right? Feels good. Obviously, it's not a huge amount. It's very small, but think about it, like, the psychological benefit and the fact that you are paying off that debt. October, right? Monthly interest of $11. You made $25 in dividends. Pretty sweet. Made $13 in profit. So again, it's not a ton of money. Psychologically, it feels good. You're paying it off, but also, like, mathematically, you are reducing that debt, which means you have less interest to pay. You can redeploy more margin if you want, but you're still making money off your account. And on the bottom here, I have the realized return plus the dividend. So we made $115 in total from actual cash returns, realized returns plus dividends from the margin account. So it's super cool. And we do have some more dividends coming up for October. We have, I think, 2 more dividends. So this might be closer to $30. And I'll update that when we get there. But again, the idea is that, like, even worst case scenario, let's say if we have a 6-month downturn, or let's say stocks, go down the tubes, at least our margin account is paying off that debt. At least we're getting somewhere. At least, things are growing and you don't have to worry about that. And that's the main reason why we have that. And again, our dividend yield is a little bit higher just to help offset that, but we do have our capital growth here as well to make gains too. So the dividends are covered, interest is covered. The only thing I have to worry about in fact, we're making money off that. The only thing I have to worry about is the capital growth. So, and this is going to be the all-time return here. So capital growth, all these different funds. So that's the main thing. When I go to sell, I just basically look at this, and we sell based off this. So it just protects us in a long downturn. We make money. It's one of the different ways of just adding more safety and being smart with the margin account and adding flexibility. So one big point I want to mention before we kind of go towards the end of this video is when it comes to the interest rates and the dividend yields of your margin account, one of the big things, this goes with traditional investing, but especially in your margin account, is you want to make sure you're buying stable ETFs in terms of dividends. And you guys can see, like, you don't have to be like 100% one way or the other. And I hate when people do this when it comes to investing. It's like, or anything in life, you're like, oh, you have to do it this way. You have to only be growth. You have to be dividend or whatever it is. Like, I think flexibility adds a lot, and especially it helps add a lot if you can mix and match things, but just do it in a smart way. And that's kind of what I've done with the margin account is 70% of the portfolio. So again, this is under ideal allocations, which, it's going to fluctuate. But this is what we're shooting for, is to be VDY, VFE, and XEI. So this is about 70%, about 30% US markets, and about 30% Canadian markets split between these two, give or take. So that's growth plus dividends. That's 70% of the portfolio. So that's a good strong base. And then we have 30% in some covered call ETFs to bump up that yield. And the reason why we did this is because, like, with these funds, our yield was pretty low. I think it was about 3% or 2%. So the covered call, whatever it was, I don't remember. But then the covered call ETFs come in and they bump it up to that, to be above the interest rate plus a little bit of a cushion. And we have a mixture of covered call ETFs, mostly Canadian funds for tax purposes, but also just because I really like the funds themselves. HHIS is our higher riskier fund with higher yield, more volatility. You got to be careful with some of these stocks, especially in margin. High volatility funds, you don't want to be holding the bulk of your portfolio in them because they will go down a lot. And I was watching when I was doing these videos to research this stuff, and I'm still learning about this. I'm kind of following some other channels that have done this with some of the higher yield funds and some of the margin accounts. And I've seen a lot of people go really aggressive with these funds, and you'll see they just are having a hard time with them, especially when the markets drop. And it's hard to get that capital back, and you're kind of stuck with the debt. So we don't want that as head of our account. We want flexibility. We want to be making enough money to cover the interest, but we don't want to be too greedy. Again, you don't want to go too high with the yield. You don't want to chase it too much. You want to kind of have a nice balanced approach here. So HHAS is about 5%. It's very low, but it does help bump up the yield, and that's the whole purpose of it. HDIV is our main covered call ETF. It's the bulk of the portfolio. It's a good classic Canadian fund. I'm just looking it up here to show you guys. So if you look HDIV up here, we can see that it's done pretty well. Obviously, it goes up and down short term. That's fine. But again, we have the base of the portfolio to protect us against that with the traditional growth funds and dividend stocks. But it's a very stable fund. Again, tax benefits for Canadian stocks and whatnot, not much. Most of it is not going to be eligible dividends, but you do get a little bit of it there. And then CDA is just a little bit more of a riskier version of HDIV. We don't know how it's going to work. It's a new fund, but I figured I'd put in there, again, just to bump up the yield a little bit. And it is Canadian based. Lots of tax benefits there too. So, make sure you're picking good quality ETFs. Make sure that you go this stable. It doesn't have to be perfect. You can mix in some higher, riskier things if you want, but just make it low percentages, right? Like, for us, it's like 70% here, about like maybe 15% here, 5% here, 5% here, or something along those lines, right? So, you're kind of doing it in a nice balanced way. And that's very important for you guys to do that, because you want to make sure, like in a downward market, that you're going to be able to actually cover that interest. All right, guys, and that's pretty much it for today's video. So like usual, if you guys have any questions, just let me know. Again, the goal the goal of the margin account is to make borrowing money smarter, and to do it in a smart way that's going to work for you, and not to make things riskier. So it's obviously tricky. You're going to be enticed with things. You're going to want to buy some things. You might want to, that is a problem I've noticed myself when you're doing this. It's very easy. You create your rules, create your boundaries. It's very easy to go a little bit higher and then a little bit higher. So you just got to remember to bring yourself back down. Be conservative just in case, to help offset that, and just take your time. Those are the biggest things I'd recommend, and it makes such a big difference. But anyways, guys, hope you guys enjoyed this video. Hope you guys are liking this series. Take care. Have yourself a good one, and I'll see you guys later.